I'm Taylor Riggs in San Francisco, and for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, a major shakeup at the top of Alphabet. Google co-founders Larry Page and Sergey Brin are stepping down from the company they turned into a global giant. But they won't have the search long for a new CEO. We'll have the latest. Plus, Dorsey on the move. The Twitter CEO is planning to spend half the year in Africa. What this means for his role at the social network, as well as Square. And security threat, we speak to the U.S. Deputy Assistant Secretary of State for Cyber and International Communications and Information Policy for an insider's view on U.S. versus Huawei. But first, to our top story. Major changes happening at Alphabet. Larry Page and Sergey Brin are both said to be stepping down from the tech giant, with Google CEO Sundar Pichai taking over that position. Now, Pichai will be both the CEO of Google and Alphabet. Page and Brin will remain active as co-founders and remain on the board. To discuss, we are joined by Bloomberg Technology's Alistair Barr. Alistair, how big of a surprise was this?
It was a pretty big surprise, actually. Sundar, there had been some questions about how much longer Sundar might want to be CEO of Google. Those questions have been bubbling up a little bit this year. Google is under a massive amount of scrutiny. He has a lot of things to juggle. There's been internal protests at the company, so this really was a surprise where basically he's had to deal with all these things, and now he's gonna be back dealing with all the other things that happen under the Alphabet umbrella, which includes self-driving cars and a host of other things.
And are Larry and Sergey really visionaries, and Sundar is a good executioner? Where do the three of them fit in when you take a look at their skills and really who they are as leaders?
I think Larry Page is the main visionary that people think of when they think of Google, and the main driving force. Larry and Sergey together, that they obviously founded the search engine more than 15 years ago, and that they really built that into what it is today. But then Larry really was a driving force behind the idea that, maybe about 7 or 8 years ago, they basically realized, Google is going to have to do something else, and to keep growing, he really pushed them into things like self-driving cars and other stuff too. And Sundar is a bit different, where he was more, his background came from a very core Google background, where he ran the Chrome web browser, the Chrome operating system, which runs Chromebooks and things like that. And then he worked his way up through the company. So he can be seen as more of an operations guy, and certainly since Alphabet happened in 2015, Sundar has been the one to deal with all the everyday things that are going on at Google. And
I want you to stay with us, because joining us on the phone is Gene Munster of Loupe Ventures. Gene, what is your initial reaction from this?
I was not expecting this, but in some ways I wasn't surprised, in part just because the tenure that how long both of them had been there. Separately is this concept that the company is moving into a different chapter, and the Google proper is the next chapter is going to be, I think, a lot around policy and data privacy and regulation. And if you think about the founders and what they've accomplished and what the next couple of years would look like, testifying, for example, and going through some of the minutia of that, I'm not surprised to ultimately see this. It is there's another part of me that's just kind of sad, because they've had such a profound impact on our lives, and just a reminder that even the greats move on.
And Gene, how much of this really can be seen as a vote of confidence in Sundar Pichai?
I mean, undoubtedly a vote of confidence. I think it's more related to what Sergey and Larry ultimately want to do than it is about a vote of confidence. But it is a vote of confidence nonetheless. If they didn't have that, then he would not be the one tapped for the broader role.
You know, Alistair, we talked a few weeks ago when you had Apple's CEO Tim Cook really work the politics, if you will. In this day and age, you're not just running a company. You really have to be working the politics, working with the regulatory issues. Is Sundar Pichai ready and able to do that?
I think he is very able from a technology point of view. So if someone asks Sundar Pichai a super complicated question about what data Google uses, how is it used, how is it controlled, how is it protected, he will know all that stuff. And he was partly behind building a lot of that stuff, especially on the web side. So technically he's great. On the showing up for a congressional hearing, that's not something that I don't think really loves to do. And he's quite a quiet person and a thoughtful person, and I don't think he enjoys being asked things live when the whole world is watching, in a sort of contentious situation. But he can certainly do it. And when you compare it to Larry Page, who really does not want to do any of that stuff, that's really the comparison to make here, because earlier this year, as scrutiny really ramped up on Google, Larry Page, everyone said, well, where's Larry? And I think this decision today kind of partly addresses that, which is, well, Larry doesn't have to be there anymore. He's not the CEO of Alphabet.
Gene, as you take a look at the company now, he's running both Google and Alphabet. What could be some of the challenges now of running both of those while the other two are now just on the board, but still controlling most of the shares?
Well, the obvious challenge is the one that we've covered pretty well here, is around policy. I think beyond that, it is going to be how much oxygen to give the other bets. And this is, as we think about what has changed in kind of late stage investing over the last 6 months with WeWork and Uber and Lyft, and some of the path to profitability questions. Even corporate sponsors of these are asking more difficult questions. And so that, to me, would be kind of the critical. I'd love to be in a room and hear the conversation related to how much to give some of these, how much funding to give some of these other bets. Do you think specifically the easy one to talk about is Waymo, and that is a radical view to autonomy, is basically launching an entirely wrapped up and tidy product, very different than Tesla's kind of evolutionary approach. This is revolutionary, and a huge amount of spending that would have to be behind that. So that, to me, would be kind of one of the key issues, and more broadly, just how they want to continue to foster other bets in that 20% other time that Google has been a foundation of working at Google.
And Gene, finally here, do you think this can be seen as a good thing, bringing this under one person, bringing both companies together, having him run both divisions, really trying to simplify under the big umbrella?
Yeah, I can see that. I mean, Google is definitely the powerhouse of the portfolio of companies, and so that makes a ton of sense. I wouldn't be surprised if in the next year or two, Sundar stays at the top and there's new leadership that's brought in for Google.
Well, thank you both to Bloomberg Technologies' Alistair Barr and Gene Munster of Loupe Ventures. Now, meantime, back here in the U.S., stocks were selling off for a third day in a row Tuesday as trade deal hopes dimmed. At Tuesday's lows, the S&P and the Nasdaq were down about 1.4%, only to finish lower by a bit more than 0.5%. But it really was the stocks that underperformed and actually finished down 1.5%. Here to talk about why this matters is Abigail Doolittle. Abigail, what is it telling us about the stocks here? Is it trade or something bigger?
You know, it's probably trade right now, Taylor, and certainly a bumpy start for stocks overall, as you were mentioning, but even more so for the stocks in that chip sector, down 3 days in a row. For the chip sector, down a couple percentage points over those 3 days, the worst 3 days since August. And the reason I say that this probably has to do with trade, the chip companies, of course, receive a lot of their revenue from Asia, the supply chain deeply embedded within China. And if we take a look at a chart in the Bloomberg terminal, it appears as though it's a bit of a binary event ahead, and we can see why the chips are a bit of a barometer, at least this year, for the trade war. Now, when we take a look at this one-year chart, we see a beautiful uptrend. That tells you overall the buyers, the bulls, are in charge. They like the chips. But take a look at that dip back in April and May. That, of course, is when trade tensions rattled. And then the same thing in August, the same thing in late September into early October. Each time the buyers stepping back in. Well, take a look at that stocks right now above that trend line. It appears, Taylor, that we'll probably have another 2% to the downside toward that trend line. If it holds, we'll probably see new all-time highs looking at the history of this chart. But if it does not hold, it could get pretty ugly. And at that point, to answer your question even more deeply, it would suggest that it could be something even more broadly than trade, or that the trade war could really eat into the global economy more so than it is.
And as we talk about trade, I mean, so often Apple is seen really as the bellwether. Apple closing down at one point, having one of its worst days really going back since August. Where does Apple fit in terms of sentiment?
Well, that's a great question, Taylor, because in all of the news today and the noise today, Apple really lost in the shuffle to some degree, but down sharply at the lows, the worst since August. And similar to the chips, it's another barometer for the trade war, considering that they received 20% of their revenues from China. But not only that, they also, of course, are their supply chain deeply embedded in China. And some of the chip stocks that sold off the most today, some of those Apple suppliers we're always talking about, ON Semiconductor, Qualcomm, Broadcom, Skyworks. So the fact that you have the Apple complex selling off to some degree, it speaks to the degree of the rally this year. Investors wanting to take some chips off the table given the jitters we're seeing right now. But it may suggest that some investors think that there may not be a deal getting done this year, and they're, selling off these Apple suppliers in particular.
And Abigail, it's notable that almost a year ago on Christmas Eve, we had that massive sell-off. Since then, it's been a big run up higher. Where do we stand as we approach really that 1-year anniversary of that major sell-off?
Taylor, that's a great question. And what an ugly day that was. And what an ugly last December was, because everybody right now is asking in terms of this December, are we climbing the wall of worry? Will we climb the wall of worry? Because right now we're not doing that with the stocks down for 2 days in a row, or too far too fast, because on this year, basically from those lows, up more than 20%. The S&P 500 headed to its best year since 2013. But look at that ugly December last year. So if you use that as a gauge of what could be ahead, investors would be rightfully fearful. However, if you look at most of the other Decembers in this cycle, going back about a decade, you see gains. So history probably suggests that the S&P 500 may finish up slightly. But right now, again, a bit of a bumpy start, and certainly on these trade concerns we're talking about.
Abigail Doolittle from Bloomberg, thank you for joining. Now, shares of Salesforce are falling in after-hours trading even as they boosted full-year earnings by as much as 7 cents, now up to $2.90 a share. The software company is also looking at fiscal year 2021 revenue of as much as $20.9 billion. That would mean the company is seeing some of the best revenue growth they've had in years. And coming up, Dorsey's big move to Africa right in time for the 2020 elections. What this means for his two companies, Twitter and Square, that's next. This is Bloomberg. Twitter CEO Jack Dorsey is off to Africa next year. Dorsey tweeted that he plans to live on the continent between 3 to 6 months. He hasn't said why, but Dorsey's plans coincide with a presidential election year. It is likely to be marked with debate over online hate speech and the role tech companies play in public discourse. To discuss, we're joined by Bloomberg Technology's Kurt Wagner. Kurt, how suspect is the timing?
It's probably not ideal. We wrote a story this morning and talked to a few analysts that were kind of like, hey, this is a really big year coming up for Twitter. Not just Twitter, but Facebook and Google and other platforms that are going to be, carrying a lot of the information about the election. And are they going to be able to fight fake news? Are they going to be able to fight election manipulation? And if you have the CEO of one of those very important companies, the one that President Donald Trump uses most often, all the way halfway across the world, what could that do to those processes they have in place? Obviously, we don't know exactly, but the question, or the timing is a little questionable.
And what you were saying in your story, it's not just Twitter, but Square, and neither of them have a clear number two to sort of run the show, if you will, if he's off in Africa. Who do we think could be in place there to help keep the show running.
Yeah, and I think you could look at this two ways. In one case, the fact that there's no obvious number two at either company, and yet they both still operate on a functional day-to-day level while Jack Dorsey has two jobs, maybe that's a sign that they don't need a number two necessarily to keep the trains on time. At the same time, at Twitter, for example, Ned Siegel, who's their CFO, does a little bit of the front-facing stuff. Obviously, he speaks at all-hands meetings, things like that. That might be the kind of thing. But more than anything, Jack Dorsey has talked a lot about remote work and pushed that internally at Twitter as this idea of this is the future of being able to work wherever you're most efficient and most convenient. Now, those might not be Africa necessarily, but that doesn't mean he's necessarily going to be stepping away for 3 to 6 months. It just might mean that he's a little harder to reach.
And generally, do we know why Africa? I mean, he's talked a lot about cryptocurrencies. How much do those two have to do with each other?
Well, he did mention crypto in his tweet as being, he mentioned Africa as being kind of this foundational region for that type of technology. He met with a ton of entrepreneurs, many of them who focus on crypto during the month of November while he was visiting there. But also, I mean, when you think about it from a Twitter standpoint, this is a global platform. There are, probably millions of people in Africa who use Twitter. These are people that probably he does not hear from very often and that the company doesn't hear from very often. So you could make an argument that, spending some time in these regions that oftentimes get overlooked could be good for, business at Twitter as well. Again, we won't really know until this actually comes into play and we know when he's gone and what the criteria is around who's going to run Twitter in the meantime. But that would be the positive spin on it.
To be fair, though, Twitter has taken probably the least hands-on approach when it comes to ads and the political election. Clearly, they're deciding not to have any of them on their platform. Does this sort of help make his case that maybe being around on election year, while it's important, maybe not as important as a Google or a Facebook?
Yeah, I think there's two elements of this. One is that you're right. They said, hey, we're not going to allow any political ads. That tends to make things easier, right? They did walk that back a little. They're going to allow some issue ads that are going to complicate things slightly. But the other is that one of their top executives, Vijaya Gadi, who's their general counsel, is actually the one who's going to be in charge of implementing a lot of these really tough decisions around content policy. So, for example, if a politician were to cross the line, it would be her decision ultimately to act or not to act. And so in some ways, that's another burden that's off of Jack Dorsey's shoulders. Someone else who's in the building and probably not going to be in Africa could make that call.
I want you to listen to a soundbite that we have of Facebook CEO Mark Zuckerberg on those political ads.
At the end of the day, I just think that in a democracy, people should be able to see for themselves what politicians are saying.
Even if the ads are containing false information.
I think that people should be able to judge for themselves the character of politicians.
And that was on CBS this morning. Kurt, your reaction?
Well, this is what he's been saying all along. Ever since we saw him give that speech in Georgetown in the middle of October, he's really stuck to the same talking points, which is that it's not Facebook's role, it's not big tech's role to really determine what's true and what's false, that people are smart enough to kind of see through these lies. If a politician were to go out and say something blatantly false, the media will call them on it and people will be smart enough to say that's a lie. Obviously, it's never quite that simple, and I think there's a lot of people who say, well, hey, you're profiting off of these kinds of ads. It's your responsibility to actually step in. But this is not a new talking point for him. We have heard him say this over and over. What's actually more interesting is that he's not really wavering despite all the pushback. Standing his ground.
Thank you, Bloomberg Technologies' Kurt Wagner. And coming up, T-Mobile and Sprint will face fewer opponents in their antitrust trial, but that's coming with a cost. That's next. This is Bloomberg. Three states have agreed to keep their doors open for the merger of T-Mobile and Sprint in exchange for better deals. T-Mobile has brokered settlements with Nevada, Texas, and Colorado in a multi-state antitrust suit. The case is scheduled to go to trial on December 9th in a Manhattan federal court. For more, we are joined by Jennifer Rhee of Bloomberg Intelligence in New York. Jennifer, what do we know about the differences between these three states and what they've sort of negotiated, if you will?
Well, Taylor, first, it is actually now 4 states. We had another one very recently, so Mississippi is in that group too. And I think it's not surprising, to be honest, that some states at this point have settled with the companies. I think initially when the lawsuit was filed back in June, you may have had different reasons for different states joining, and some may have been just concerned about making sure to negotiate a remedy beyond what the companies negotiated with the Department of Justice and with the FCC to ensure that some of those promises about 5G build out were going to actually go to their state and go to the populations of their state. So if you look at the 4 settlements, they're very similar. They all involve agreed, promises to build out 5G to certain portions of the population of the state within 3 years and then more within 6 years. Some of them actually include payments to the state, and some include guaranteed employment levels within the state.
Jennifer, do we have any sense if this thing really will go to trial December 9th, or do we think that we could see a more broad-based settlement before then?
Taylor, I think we could see more settlements, but I'm very certain it's going to go to trial. It starts Monday. I don't think New York and California are interested in this point in settling the suit. I think something else will have to give in order to break that logjam. And the parties are gearing up. They've just filed their pretrial briefs, and the states that are still in, which is 13 states plus the District of Columbia, look pretty dug in still.
Jennifer, I want to show you a chart that I'm showing here on my terminal at GTV Go, basically tracking T-Mobile in blue and Sprint's share price in white. Sprint pretty much unchanged, really going back the last year or so. And analysts are a little worried. A lot of analysts on the street are hoping for a deal because they think states have a really good argument as they head into trial. How much pressure is this putting really on Sprint and T-Mobile, frankly, to make a deal?
Look, I think it's putting a lot of pressure on them. This has been in a really extended interim period since they announced this merger to now. It really puts a strain on companies' business, particularly the seller's business, during that interim period. They have a lot riding on it, and Sprint did not negotiate an antitrust breakup fee, which means that whatever hurt, however they were hurt during this interim period, they're not going to get recompense for it after the trial if, in fact, the deal is blocked. So I think there's a lot riding on it, and I think they're probably working hard to try to settle with the rest of the states.
And any sense sort of what the competitors' feelings are? I mean, T-Mobile's coming out and saying that they're first to have 5G, and they are going to be a real threat if this settlement or the merger really between T-Mobile and Sprint goes through. Have we heard anything from some of the competitors about this?
I think the competitors have been quiet about it and have been quiet about it for a reason. When a competitor complains about a deal, it can actually have a strange effect on the way the DOJ might look at the deal. A competitor complaining could suggest that the deal is actually competitive, that it'll force that other competitor to lower their own prices and compete more strongly. So, Verizon and AT&T have been quiet about it, and I think that they're just watching because, in fact, there is a pretty good argument here for the states in trial, and I think it's very difficult to predict what's going to happen and whether this deal is actually going to be able to get closed in 2020.
Bloomberg's Jennifer Rhee, thank you for joining us. And coming up, we'll get an insider's look at U.S. versus Huawei. Our conversation with U.S. Deputy Assistant Secretary of State Rob Strayer. He's next. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry Ann in New York and Heidi Stroud-Watts in Sydney. Let's take a look at those top global tech stories of the day. Heidi.
Taylor, France says the European Union will retaliate over the proposed U.S. response to its digital tax law. The tax hits large American tech companies such as Google, Apple, Facebook and Amazon. On Monday, the Trump administration announced that it may slap tariffs on $2.4 billion worth of French wine, cheese, handbags and other products. Well, starting Tuesday, Amazon needs to shake off a patchy record in live sports. The company's Prime Video service will begin showing the world's richest soccer competition to millions of fans. Amazon is carrying 20 English Premier League matches this month. Previous attempts by Amazon to live stream sports have been marred by technical glitches. And a California college student is suing TikTok. The suit alleges that the company is secretly funneling her data to China and that TikTok is using her videos to create an online profile for targeted ads. TikTok has come under fire in the US for alleged national security concerns, including a review of its $1 billion purchase by China's ByteDance. And those are your top global tech stories that we're watching. Sherry.
Heidi, thank you. The Trump administration has been looking at Chinese tech as a national security threat for some time now, and it's focused on companies like Huawei, ZTE, and TikTok. To that end, a new U.S. agency has a $60 billion budget to help developing countries and businesses find alternatives to companies like Huawei and ZTE. Joining us now from Washington is Robert Strayer, the State Department Deputy Assistant Secretary for Cyber and International Communications and Information Policy. Ambassador, thank you so much for your time today. Now, this latest approach seems to be the carrot approach, where you're trying to convince these developing nations to stay away from cheaper Chinese tech. Is this an acknowledgement that perhaps the stick is not working?
Well, for some time, we've sought to work with developing countries to ensure that they can have reliable and secure communications technology. So this isn't a different approach to the matter. Independently, we're also working with partners and allies to educate them about the risks of 5G, that there can be the potential for vendors of 5G to be under control of another government that would require them to take actions that are not in their citizens' interests. And that's particularly the case in countries like China, where there's no independent judiciary or rule of law for a company to object to be made to take actions in line with their intelligence and security services.
So back in September, you said that there could be punishments for allies that refuse to ban Huawei equipment in their 5G networks. What's being discussed?
Well, we've said for some time that we want to maintain our very close cooperation on law enforcement and military matters with governments around the world where we already have those robust relationships. But when we're not able to share information securely, as would be the case when they have untrusted vendors in their 5G networks, we're going to have to reassess how we share that information in the future. And that may make it difficult for us to have such robust information sharing relationships in the future.
You know, Ambassador, when we take a look at that $60 billion fund or budget that could be used to help stave off some of the competitors, any chance that that is going to be used on U.S. companies, or is that strictly going to be overseas companies?
Well, I think it's important to recognize that when people talk about competition in this space, largely they're focused on the radio access network vendors. And there's three main alternatives to Huawei, which are Ericsson, Nokia, and Samsung. But beyond that, the components that go into a lot of this gear are American or at least Western European. Those include companies like Qualcomm, Juniper, Intel, and numerous other companies that are in the United States. So a lot of companies stand to gain from selecting a trusted radio access network vendor for future technology.
You know, Ambassador, in Europe, I think Germany and France have been hesitant to block or ban a specific company like a Huawei or a ZTE. How do you work with them to get them on board and see the risks that you see and potentially actually ban a specific company?
So we're not trying to get them to ban any particular company. We've been working for more than a year now to educate them about the risks of 5G networks. The most important feature to understand is that software can be updated instantaneously, and that update can contain a backdoor or a compromise that disrupts the system. So we've been talking to countries not just about applying secure practices from a technical perspective, but also having to apply measures of what are trusted vendors in their networks, how to identify what are the criteria of what would be a trusted vendor. And most fundamental of those is that the vendor must be headquartered in a country that has the rule of law and an independent judiciary. Other factors, go ahead.
Please go ahead.
I just say the other factors to ask them to look at are the transparency of ownership, and as well as its funding mechanisms for the company. So in the case of a company like Huawei, what is the role of the Chinese Communist Party in the company, and who actually owns the company? It's claimed to be owned by 99% private ownership, but in fact, that ownership is probably controlled by the Chinese Communist Party.
Now, we keep hearing these allegations of security threats coming from Huawei, but other than a few allegations of vulnerability, say, related to Vodafone, we really haven't been seeing much in terms of evidence. So how much evidence have you seen on those backdoors and cyber threats so far?
Well, so we know the United Kingdom looked at Huawei's technology. They've had a relationship with them for over 9 years. And every year they find that there to be serious and systemic software engineering defects and cybersecurity challenges. So they're finding hundreds of defects. Really effectively what we have here is a bug door that has so many vulnerabilities in what Huawei is producing that it's impossible to really determine if there was intent to put one of those there for a future vulnerability that will be compromised. We've also had a US company look at the firmware, that is the software that resides on the hardware of routers and switches, and they found to be on average 100 vulnerabilities in each piece of hardware that they looked at. So it's replete with vulnerabilities. The real question is, what will China do when it has both the intent, the capability, and the opportunity when a 5G network is fully deployed? When our critical infrastructure is riding on these networks, that's when there will be real temptation to use 5G as a point of leverage against Western nations.
Ambassador, I've put that question of vulnerabilities to the chief security officer at Huawei, and his explanation was that they don't have the access to critical information, customer information that the U.S. says, that those are actually controlled by telecom operators. Does there need to be a more coordinated effort when it comes to those equipment vendors and telecom operators instead of just banning certain companies?
Well, again, we want to see practices put in place that will ensure that the hardware and software are being produced by trusted companies. It's fundamentally the case that Huawei or ZTE is writing tens of millions of if not even more, lines of code. Nobody can test their way or investigate their way through the process to determine that that technology is secure. It relies fundamentally at the end of the day on trust. There's numerous cybersecurity best practices can be put in place, but trust is going to be the bottom line with this technology.
Rob, when we take a look at trust, Germany has hinted that they're looking at a joint China approach where they would set up an agency to help oversee some of the 5G technology coming from China. Why wouldn't that approach work, in your opinion, if we were to do that here in the U.S.?
So there can be some benefit to testing and evaluation, but it's simply hubris to think that we as human beings are going to, and even with the assistance of computers, they're going to be able to find backdoors in software and hardware that are put there by sophisticated nation states. Huawei and ZTE are fundamentally in the position that they have to take action when they're required to by the Chinese Communist Party. And they should not be allowed to provide the most secure of our technologies that mean so much to our economy and our security future.
State Department Deputy Assistant Secretary Rob Strayer, thank you for joining us. And plenty more global stories ahead. Next, this is Bloomberg. By now, you've all heard the story about WeWork and its fall from overvalued grace. But did you know that the company had been touting a cash flow metric to show that its core services are profitable? That is, once you subtract out things like rent, marketing, and stock compensation. The alternative metric, known as contribution margin, allowed the company to flip a $1.9 billion net loss under U.S. GAAP into a $142 million profit. And it's not the only one using that tool. You can look at Lyft and Peloton as well, also using it. But now the SEC is raising concerns about that metric's use. To discuss, Barry Oxford, Senior Research Analyst at D.A. Davidson, and Triton Research CEO Rhett Wallace. Rhett, I want to start with you because in August, you looked at the prospectus, really, of WeWork and said that it was a master of obfuscation. What do you make now of this latest news about the SEC looking at that new cash flow metric?
Well, so it makes complete sense to me that the SEC would be looking at the way these companies present themselves, especially given the size of the loss profile. I think what we would say looking at it is it's not that helpful to investors to take the big negative on the profit line and add back a lot of expenses. Investors can sort of do that for themselves, right? With the issue in these documents that we've seen isn't so much what's there, whether it's a real GAAP metric or these sort of alternative facts metrics, but what's missing. I mean, Peloton, since you brought it up, is a really good example of a company that decided to disclose the kind of metrics that you're used to seeing if you're a private investor, like customer acquisition cost, churn, customer value, and things like that. So, if the SEC was to call us up and ask us what we think about this stuff, we would say that it's not so much, that these other alternative things are misleading because they're sort of neither here nor there, but what we'd like to see is a little bit more of the operating metrics that the operators and the early investors get to see.
And Barry, what is your take on this about subtracting some of those key costs out from the income statement?
Sure, Taylor. I think that when you look at some of these adjustments, I think that they need to be more kind of secondary. I think that in the document, I think that WeWork's kind of put that community adjusted number kind of more front and center, and I don't think it's appropriate for valuation purposes when it comes to the company. However, that being said, there is a fundamental question is, when these units for WeWorks are up and running, are they profitable? And so that metric is helpful in that standpoint in answering that question. But to put it as front and center as a major way in which to value the company, I disagree with how they kind of presented it.
Yeah, Red, I want to talk a little bit more about WeWork. In your August report, you were highlighting the way that they were reclassifying some of those expenses, and after a few years of being open, they would move them pretty much off or to a different part of the income statement. Is that normal? Is that done a lot, or was this a WeWork specific issue?
Well, I mean, WeWork, itself is a specific issue, right? Just across the board, there's really nothing comparable to WeWork. It's, and just the disclosure is just the smallest part of it. But because WeWork is really sort of, 550 little companies, what we were looking at is the unit economics, or what we were looking for but not finding was the unit economics. And I think the thing that you're mentioning here is that they took some expenses away from the, the central parent company that's responsible of doing development, and then farmed it out to the individual units. And the reason that was problematic is you couldn't tell, how much those dollar amounts were, because they said that they did it after the units had been up for 24 months, but you didn't know when they were opened. And so what it did, it just created additional confusion in a situation that was already really confusing. I think that, again, if we were going to talk about the unit economics, the units at WeWork are really not difficult to understand, right? You have an office and you pay the landlord for that based on your, your long-term lease, and then you take in rent from your tenants. And so the fundamental simplicity of the business model was not evident in the way that they chose to disclose the overall parent company financials, and so it was just an opportunity to be more transparent that they decided not to take advantage of.
Barry, you brought a community adjusted EBITDA, and I found that very fascinating because we spoke a few weeks ago and you seem to think that it was helpful. So as an analyst, how is a term like that doesn't seem to appear to be in GAAP accounting standards helpful to an analyst as you're looking at the company?
Right. Well, I think as Rhett kind of pointed out, when you're trying to look at the simplicity of the business model, and do they have enough leases out there that support the cost structure, meaning the lease cost and some, operational and marginal marketing expenses, it is helpful. But again, you can kind of move stuff around on the different line items based upon how it could make your financials look a little more favorable on where you want to kind of classify different expenses. And so it wasn't always clear in that case.
Red, I was taking a look at some of your research, and you actually have an obfuscation index where you list the companies, and Lyft as well ranks pretty low on that index. What is Lyft also doing that raises some of your concerns?
Oh, I mean, it's not nice to pick on individual companies, but, when you have a consumer company that, lives or dies by its unit economics, to not disclose the number of units is just sort of, an investor hostile thing to do. And so, if we were going to go back to, looking on the bright side of things, WeWork put out some disclosure not very long ago that showed all of the units so that we could see what the customer acquisition costs and the churn rates were and so forth. And so, to us, it's just really straightforward that, investors would like to be able to pencil out that math before they hand over billions and billions of dollars. Now, the obfuscation index, the reason we do that is because a company's willingness to obfuscate is usually something that actually is information itself. And so that turns out to be a strongly predictive measure of a company's inability to get into the public market in a seamless way. And so that's why we do it. And we wish we didn't have to. If we could get rid of the obfuscation index, nothing would make us happier.
Well, I've decided I'm going back to accounting school for our next conversation. That was Rhett Wallace of Triton Research and D.A. Davidson's Barry Oxford. Thank you both for joining. And still ahead, back to the news of the moment. Larry Page and Sergey Brin are stepping down from their roles as CEO and president of Alphabet. How newly tapped CEO Sundar Pichai will manage the company ahead. This is Bloomberg. Back to our top story. Google founders Larry Page and Sergey Brin stepping down from their roles at parent company Alphabet. Current Google CEO Sundar Pichai will also now become the CEO of Alphabet. For more, I want to bring in Brent Thill of Jefferies, who currently has a buy rating on the company. Also with us, Bloomberg Technology's Mark Bergen, who covers the company. Mark, how surprised are we by this?
We're a little surprised, but we're surprised as we were 4 years ago when they announced Alphabet, right? And then I think after the dust settled, it was like, oh, this is fairly obvious, right? Google, at that point, Sundar Pichai was effectively the managing all of Google. And you can make the same argument now that he's been effectively, he's on the board of Alphabet. He's been involved with, Google is, 99% of the revenue for Alphabet. It's a bulk, almost similar percentage of the workforce. So in this sense, it's sort of someone, I talked to a former Googler today who said it gives corporate structure to a reality.
Brent, in your analysis, as you take a look at the company, what changed for you a few hours ago?
Nothing at all. Sundar's done a great job. The stock's up 24% year to date, doing very well. It typically does well in odd years and doesn't do as well in even years. So I think everyone's a little concerned about next year. But stock's doing well. The company's performing. The multiple on the stock is still very reasonable relative to its EBITDA growth. And look, I put myself in the shoes of, can you imagine if you founded this company 20 years ago and you're worth over $50 billion and there's a super capable person in charge? I think there's a lot of other things in life that they get to explore. So I don't think anyone's surprised. Clearly, well-deserved and incredible run. As they said, they're going to remain board members and shareholders. And again, north of $50 billion, there's a lot of other things in life to do.
So, Brent, do you see this as a vote of confidence in Sundar, or they needed the founders to step down? I mean, is this really just letting Sundar take over and do what he does best?
I don't really think there's a ton of change. I think they've said they're going to be available. They're going to be there. They're going to be advisors. I'm sure if Sundar needs to make a call to them, they're going to pick up the call and vice versa. And so I don't think anything's going to change. They've said this, that, the up and coming businesses that are inside of Google that are the next big businesses, they're all equipped with their own operating teams. They're well funded. They have, I look at Waymo and Verily and some of the other businesses. They're super exciting, and they've got a lot of great momentum. So I don't think that this is not a rudderless ship. They have a great team, and Ruth has done a great job on the as a CFO, and she's now become, I think, more shareholder friendly with the actions around the buyback. This company is one of the biggest buybacks they've ever had. So from a shareholder perspective, the way we look at this is a terrific investment still. We think that there's really no issue here that I think this is more like headline excitement, but fundamentally, I don't think anything's going to change.
So, Mark, you heard fundamentally perhaps no changes. Arguably, Sundar Pichai would agree. He's coming out with a statement and saying this transition won't affect the Alphabet structure or the work that we do day to day. I'll still be focused on Google and doing the same work of pushing the boundaries in computing. So what changes for him really tomorrow morning? Yeah, I mean,
I'll make the opposite argument here that like 4 years ago, they put out Alphabet. It was this big, ambitious bets on autonomous driving, on biotechnology, sort of all these ambitious fields outside of Google. Nest was one of the big companies, and then you fast forward the 4 years, Nest is back inside Google. Google Fiber has all but collapsed. Waymo they're certainly much more critical about the progress they've made on self-driving cars. These biotech investors are very long, decades out in returns, not something that Sundar has had experience. He's never run a biotech company, right? And so there's something kind of almost symbolic of the fact here that the founders who set the tone and the culture for this company for 20 years have receded and now officially kind of stepped away. And so I think there are a lot of open questions about the rest of Alphabet outside of Google that now Sundar has to answer. There's certainly, and that doesn't say anything about the political questions he has to wrestle with.
So, Brent, I want to go there. We bring up the political questions. That is clearly one of the big overhangs facing all of big tech is some of the regulatory pressures. Tim Cook at Apple seems to have a good relationship relationship with the president, working with him to work at those tariffs and remove those tariffs. How do you view Sundar in the context of a relationship with the president, or being able to go to D.C. and tackle some of the big antitrust and data privacies that are really overhanging on the company?
All the big tech platforms are underneath the same scrutiny. We cover Amazon, Facebook, all of these. They're all underneath the same microscope. I think they've been operating under that for quite some time. And I've said this repeatedly, having covered tech for 25 years and watched Microsoft go through this, they performed extremely well. So you have to separate the noise from the reality. And Microsoft was a fantastic stock to invest in the turmoil of the regulatory overhang in Europe. It will not have an impact. And I've said this since the beginning of the year. Facebook stock's up 51% year to date. Google's up 24% year to date. Did you want to be invested there? Absolutely. The regulatory issue will always be there. It will be there for everyone. And it's what they do. And they've been doing this for a while. I think Sundar said this on one of the last earnings calls. We've been dealing with regulators for 15, 20 years. So I don't think that, anything has changed. I think clearly this overhang creates a worse sentiment. And that sentiment's great because they keep putting up great numbers. When you have bad sentiment and good numbers, stocks go higher.
Well, the story of the day. So thank you to Brent Thill of Jefferies and Bloomberg's Mark Bergen. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.